Hi, I'm Jimmy. In this video, we're looking at AT&T, ticker symbol T. This video is part of our Dividend Aristocrat series, where we're analyzing each of the companies within the Dividend Aristocrats ETF. The goal of this series is to see if we can find the top Dividend Aristocrat stocks that have a good chance of paying us a reliable dividend and ultimately getting us closer to our goal of achieving financial independence. Okay, so many of us dividend investors know that AT&T is a fan favorite because they have a solid dividend yield and, in theory, they have a great dividend history. So this is AT&T's dividend history going back to 2004. And as we can see, their dividends, they're the ones in the blue bars. Well, dividends have been gradually rising every year since 2004. It's actually before that. And earnings per share, well, they're in the orange bars, and they have consistently covered the dividends per share, which is exactly what we want from our dividend stocks. Okay, now let's look quickly at AT&T's business, and then we'll try to value AT&T's stock using a discounted cash flow valuation model. So we can break AT&T's business into four main segments. The largest is the communication segment. Now, if we wanted, we could break their communication segment into smaller segments within that segment. For that, we have mobility, the entertainment group, and their business wireline segment. But then when we switch back to their main segments, now we have their second largest segment, which is Warner Media. And I actually think this is one of the issues with AT&T in general, because the further we break into each segment, the further we look into each segment, well, they have segments within segments within segments, and it can really overcomplicate the business. So to illustrate, Warner Media can be broken into Warner Brothers, Turner, and HBO. Now, here's my issue with this, switching back to the main segments again. Now, my issue is that AT&T's business is way more complex than it really needs to be. See, we looked at their two main segments, and then we broke down each of those segments quickly into subsegments. But crazily enough, the fun doesn't stop there. They go even further, breaking down those segments into more segments, and sometimes an additional segment on top of that. To illustrate, this is what their breakdown would have looked like at different levels. And to me, I found this tricky to go through and try to identify where there were potential opportunities or where the potential threats might lie. So the first thing I'd love to see is for AT&T to clean a lot of this up. If they ultimately went out of their way to simplify the business, I think that would make it much easier to analyze and much easier for investors to get on board and properly value the stock. Now, I think some of this has happened because they've made so many acquisitions. Some good, some bad. But either way, I think it would be much easier to forecast the business if they gradually cleaned all this up and sort of rebranded things and kept them much more uniform than they currently are. Okay, moving past that to the most recent earnings announcement. So just a week or so ago, AT&T came out with their earnings. And in that earnings announcement, one of the focal points by management was their need to reduce debt, or at least call it their long-term goals. One of their long-term goals was to reduce debt. And that's a good thing, because this is what their debt looks like going back the past few years. And this is a ton of debt for a company like AT&T, for any company really, to have this much debt. And this debt is actually closely tied to what I mentioned a moment ago about cleaning the whole business up. See, some of the jumps here are related to some major acquisitions that AT&T has made. For example, back here, the jump from 2014 to 2015, that's back when AT&T acquired DirecTV. And then the jump from 2016 to 2017, well, that's what happened when they acquired Time Warner. So one of the goals that AT&T's management has stated is that they want to pay off the debt from the Time Warner acquisition by 2022. I think that was about $40 billion in debt, if I'm not mistaken, of debt that they're trying to pay off by 2022. So I think that that's possible. They have enough free cash flow and enough earnings per share to potentially handle that type of thing. And I think that they're heading in the right direction operationally as they try to improve their operational efficiency and lower expenses. And cutting this debt will be important to the value of AT&T stock. So now I think it makes sense for us to jump over to our discounted free cash flow model. So this is the discounted free cash flow valuation model that I put together for AT&T. Now, I'm not going to spend too much time walking through how all of this actually works. I did a video on the whole thing, on the whole process, if you're interested. I've got a link in the description below on the video, and I also put together an Excel template. I can email that to you if you're interested. There's a link below for both the video and the Excel template. But basically, here's the gist of it. We took analyst estimates as far as free cash flow is concerned, And based on their 2019 free cash flow numbers, it seems to me that the analyst estimates are somewhat reasonable. They put up $29 billion in 2019, so analyst estimates, they don't touch that for the next 4 years, and I think that's very reasonable. Then we use a required rate of return of 8.5%, and I've been using 8.5% consistently on all of the companies in our Dividend Aristocrat series to try to keep things consistent. I'm assuming that's what we're trying, that's our required rate of return. So I've consistently stuck with 8.5% no matter what valuation method we're using. Then used a perpetual growth rate of 2.5%, and that gives us a fair value of the company of about $451 billion. So if we divide that by the shares outstanding, we get a fair value for AT&T stock of about $62 per share. And to me, this might seem like a bit on the high side. I'm sure any of us who know will realize that AT&T stock is currently trading at about $38 per share. So clearly, 62 is a bit high. And obviously, the main reason for this is the massive amount of debt that AT&T has. Now, technically, if we don't include the debt, if we don't include an adjustment for debt, then technically what we're doing is we're valuing the entire company. So if the company had no debt, well, they would be worth about $62 per share, assuming you believe the inputs. Well, if they had a modest amount of debt, oftentimes you could just stop here if it's a reasonable amount of debt. And I think the cleanest way to determine a reasonable amount of debt is by looking at how the company trades on average versus a reasonable calculation of fair value. Now, I've done a few videos on AT&T in the past, and each time we do, we use a discounted free cash flow valuation method, and it was always a bit high. But once we account for debt in our free cash flow valuation method, well, we ended up with a fair value of AT&T stock of about $38 per share, which is once again right about where they're trading now. So hypothetically, if AT&T were to pay off $20 billion of their debt right now, well, they would have net debt. We would adjust net debt from $172 billion down to $152 billion. And just like that, the fair value of the stock would jump up to $41 per share. So this could give us a good potential idea of if they were to pay off debt, well, what would the stock, hypothetically, what would it go to then? And I believe that management said that they want to pay off about $40 billion by 2022. So if they did that, well, $40 billion would be adjusted and the stock would be worth about $44 per share. So for many of us, this may be a great return as far as dividend investors are going, as far as dividend investors are concerned, because right now they're paying a dividend yield of about 5.5%. Plus, if we would get capital gains, assuming we bought it at $38, we get capital gains up to $44 per share. Well, maybe we're in pretty good shape at that point. Now, I do think it makes more sense to buy this at a discount to our calculation of fair value. The issue with using the $44 number is that we then have to assume that they're going to pay off the debt. We have to believe that, and then we sort of have to pay as if they've already done it. I think it makes more sense to stick with the $38 per share and then try to buy it at a discount to that. Let's wait for a pullback in the stock. Now, if you're wondering how I go through my entire research process of, coming up with the fair value or understanding the segments that the business operates in, where to find this information, what order, how do you go about researching a company you know nothing about? If we knew nothing, where would we start? What's the whole process? Well, I actually did a video where I break down that process into 8 steps, where I tell you more about what information to go through and where to find that information. So if you're interested, that could be a good next video for you to watch if you're curious how to do this on your own. There's a link right here and there's a link in the description below. And I want to thank you for sticking with me all the way into the video. Thank you. I really appreciate it. Thanks, and I'll see you in the next video.